Alright, guys, so let's talk about the US economy today and let's do a much needed update. We have the stock market making all time highs and everything looks fantastic. But if you've been paying attention, you know things aren't quite that simple. The current trajectory of the US economy points us to a resurgence in inflation that's coming, which will ultimately lead to a big melt up in the markets. The US CPI is rising back up more than the forecast. Core inflation has risen by 0.3% in September for 2 months in a row. Now, core CPI is the Federal Reserve's preferred metric, which means they have to admit they are losing the inflation fight. If we look at the trend of inflation, it's quite obvious that the real battle has stalled. The headline might have dropped to 2.4%, but the real deal is core inflation, and it accelerated up to 3.3% in September. That's the same month the Federal Reserve cut interest rates by 50 basis points. We are back to the levels in June. Obviously, this is going to mess with the thought process of Jerome Powell. He needs to slash interest rates because the US economy isn't doing well. That's why he made the big cut in September in the first place. But inflation is staying stubborn. Shelter has increased by 4.9%, while food inflation has risen by 2.3%. Services are also up by nearly 5%. And all these are the staples of life. The US consumer is still feeling the heat. Putting food on the table and paying rent is getting worse every single month. Oh, but it gets worse here. Because of the recent jobs report, the US economy looks like it's booming, like it's overheating. And here's how misleading all the headlines are on Wall Street. US jobs report crushes expectations as the economy adds 254,000 jobs. The unemployment rate has fallen down to 4.1% as well. By all indications, it looks like we are headed for soft landing and there's virtually no risk of a US recession coming. Remember, this is what the Federal Reserve is observing. The labor market looks extremely strong. It's really important we look at the trend of the jobs data. Remember, it doesn't matter that the majority of payrolls are government jobs. It also doesn't matter that private sector positions have probably fallen. Here's what the Fed sees. The jobs added in September is the highest in the last 6 months. Unemployment is also starting to trend down from 4.3% to just 4.1%. Hourly earnings have risen by 0.1% as well. This is Bidenomics, guys. On the surface, everything looks fantastic, and that's all the Federal Reserve cares about, the optics. At this point, a micro cut of 25 basis points is baked into the cake. Powell, he's essentially trapped. If he cuts by 50 points in November, it could unleash one of two things or even both. The stock market could implode under our feet, and this would be an admission that the US economy is in trouble. That despite the wonderful data, the Federal Reserve has to cut by 50 points. Now, the second risk is to reignite inflation at a very critical time. Thanks to the Middle East war and the threat of escalations, the price of crude has flown up. It has gone from $72 to nearly $80, and that's a 10% rise in price in just 2 weeks. Remember, this is in October. This energy spike in prices is naturally going to reflect a high inflation reading in the next report. So there's going to be extreme pressure on the Federal Reserve to keep rates higher for longer, which in this case means a 25 basis points cut. If we look at the Fed Watch tool, which tells us the prediction of traders, the micro cut is a done deal. 82% of the market believes the Fed will cut by 25 points, while 18% of people believe the Federal Reserve won't even touch interest rates. A 50-point cut is not even on the table. Powell is essentially cornered. If he doesn't cut, the markets will implode, and if he cuts by 50, the markets will collapse as well. That's how fragile the US economy is.
Yes, yes, yes. I told you we're going to have a soft landing. We're going to have a soft landing. My policies are working. Start writing that way, okay? All right.
Now let's get this clear. The US economy is still going to ease monetary policy despite what Biden or Yellen is saying. The underlying fundamentals of the economy are extremely weak. To really underscore this, we need to look at US corporate earnings. If people are spending less, this will reflect on the balance sheet of the biggest companies in the US. In Q3 this year, earnings of the S&P will rise by only 4%. Contrast that to 11% reported in Q2. It's an enormous drop that tells us consumption is collapsing. And if we strip away the magnificent seven companies like Nvidia, the earnings forecast is even worse. Q3 growth is only 1%. If this is already happening to the biggest companies in the US, smaller businesses are in crisis mode. Powell has no choice but to cut rates down. And this poses a very big problem for the US economy. It sets up the scenario for a great melt up in the markets. And yes, even though asset prices could continue rising, it's not a good thing. And let's define what a market melt up is. It's when stocks and assets in general keep going up even though the underlying economy is weak. It's all about market psychology and investor herding. This is the biggest crisis we face in 2025. A market crash is actually a good thing, believe it or not. It's a price reset that allows people to slowly accumulate assets at reasonable prices. The keyword reasonable. But the setup we are seeing is just going to rocket things even further. Understand what pushes asset prices higher. It's when the money supply continues to expand and the supply of assets stays constant and people start piling in. Keeping rates higher for longer is going to worsen the US debt crisis. The US deficit has officially hit $1.8 trillion this fiscal year. Interest payments on the debt alone are now bigger than the entire budget of the Pentagon, and let that sink in. The US government has borrowed so much money that it is impossible to pay it back. Interest payments on the debt alone for 2024 is nearly $1 trillion, and that's more than Medicare or the defense budget. It's almost 4 times the education budget of the entire United States. And this puts the federal government in a very big quandary. They have to pay their bondholders no matter what, and this could be other countries like China or Japan. It could be investors like you and me who hold treasuries. It could be all the banks and hedge funds. The only option left is to borrow even more money at high interest rates. So the money supply is going to balloon because the US Treasury has no choice but to issue more and more bonds. Remember, that is part of the money supply. It's part of what they call the M2 money supply. The cash you have in money market funds is contributing to this as well. And here's why this is a crisis. Over the next 10 years, the 10-year interest cost will pile up to $12.4 trillion, and that's at least 1.2 trillion a year, which is a very conservative estimate. The US government will be forced to borrow money or even monetize the debt to pay back bondholders. And yes, that means money printing. So the money supply once again is forced to grow bigger and bigger. And as investors, when you get the payments, the bond payments, there are only two things you can do with the money, more or less. You either buy more US bonds and increase the money supply even further, or you start buying assets. It's not a coincidence that the stock market is at an all-time high. It's also another reason why gold has passed $2,600 an ounce. It's almost making historic highs every single month. But as an investor, you aren't going to hold on to all your bonds, right? It just doesn't make sense because the Fed is going to drop interest rates down. This is the Fed's dot plot, and it tells us where interest rates will be going for the next 3 years and beyond. This is the plan from the Federal Reserve themselves. By the end of this year, interest rates could drop down by a full percentage point to 4.25%. By the end of 2025, rates will go below 3.5%. In 2026 and beyond, interest rates will drop to 2.75% and stay there indefinitely. So understand this, US bonds will start to yield less and less over time. And when investors realize this, we can expect an exodus of money to leave. The money will pour into other types of assets. And I want to share how much firepower is laying dormant in the market. It's really mind-boggling and it's terrifying at the same time. But it shows us that a great melt-up or a reverse crash might be coming. There's a record 6.47 trillion sitting in US money market funds, and that's over 10% of the entire market cap of the S&P 500 of US stocks. It's a lot of money that will flee given the right conditions. Remember, money in these funds are investments sitting in short-term bonds. While the amount is still growing, this trend is going to reverse over the next 6, 12, and 18 months. As the Federal Reserve drops rates down, bond yields and investor returns are going to plummet as well. If core inflation stays sticky at over 3%, While you're getting 3% as well on your bonds, what's really the point? You are flat or even losing purchasing power. You are losing to inflation. This is the debt disaster that could trigger a melt up in the months and years to come. We really have the perfect recipe for disaster here. Inflation is still uncomfortably high. The US debt is still compounding, while rates will slowly but surely come down. And let's not forget we are in an era of geopolitical competition. The US, as we all know, wants to remain on top of the economic order while containing China. And this is something you can't do for free. It will cost you a ton of money and fiscal firepower. And yes, the spending will come from deficits once again. In 2020, Bank of America came out with an estimate to just relocate Chinese supply chains. It will cost the US and the EU at least $1 trillion. And that's the cost of moving manufacturing back to the West. But realistically, it's going to cost double or even triple that. China's dominance in global industries is even stronger today than ever before. So the US economy is caught in a never ending cycle of debt and spending. The Federal Reserve is also going to make things worse because they just don't want to embrace a recession. The biggest risk today isn't a total market collapse, that's becoming less and less likely. In contrast, the risk of a global meltup is starting to rise fast, which will unfortunately drive even more inequality. But let me know what you think. Is a great meltup coming for the US economy? And is it all over at this point? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.